Right now, millions of Social Security recipients are paying federal income taxes on up to 85% of their benefits, money they already paid taxes on when they earned it. But there's breaking news that could change everything, and what I'm about to share could save you thousands of dollars starting in 2026. I'm talking about the You Earned It, You Keep It Act, a bipartisan bill that would completely eliminate federal taxes on Social Security benefits forever. Not reduce them, not raise the thresholds, eliminate them entirely. Let me break down exactly what this means for your wallet, who's behind it, and most importantly, what you need to know about the current tax situation while we wait to see if this becomes law. But first, let me share something that might shock you. In 1984, less than 10% of Social Security recipients paid taxes on their benefits. Today, nearly 56% of recipients are getting hit with taxes. That's not because benefits got more generous. It's because the income thresholds that trigger taxes haven't changed since 1984. Think about that for a moment. The thresholds are still $25,000 for singles and $32,000 for married couples, the same numbers from when Ronald Reagan was president. Meanwhile, everything else has gone up with inflation except these limits. You know what this means? If you were barely avoiding Social Security taxes in 1990, your income probably looks exactly the same on paper today, but inflation has pushed you way over the threshold. It's not that you got richer, it's that the government never updated these outdated limits. This is what economists call bracket creep, when inflation pushes people into higher tax situations even though their real purchasing power hasn't increased. It's been happening to Social Security recipients for 4 decades. Here's how the current tax system works and why so many of you are getting blindsided by tax bills you never expected. If your combined income exceeds $25,000 as a single person or $32,000 as a married couple, you'll pay federal income tax on up to 50% of your Social Security benefits. If your combined income exceeds $34,000 for singles or $44,000 for couples, up to 85% of your benefits become taxable. Combined income includes your adjusted gross income, plus any tax-free interest you earn, plus half of your Social Security benefits. So even if Social Security is your only income source, you could still owe taxes if you have savings earning interest or other retirement income. Let me give you a real example. Say you're single and receive $2,000 monthly in Social Security. That's $24,000 per year. Half of that is $12,000. If you have just $13,000 in other income, maybe from a small pension or retirement account withdrawals, your combined income is $25,000. Congratulations, you now owe federal taxes on your Social Security. Here's what makes this particularly frustrating: that $13,000 in additional income might be coming from a 401k that you funded with money you already paid taxes on during your working years. Now the government is taxing you again on the Social Security benefits you earned with that same previously taxed income. It gets worse. Let's say you're a married couple, both receiving Social Security totaling $3,000 per month or $36,000 per year. Half of that is $18,000. If you have any additional income above $14,000, and remember, this includes tax-free municipal bond interest, you're paying taxes on your Social Security. For many retirees, this comes as a complete shock. They planned their retirement assuming Social Security would be tax-free, only to discover they owe hundreds or thousands in taxes they never budgeted for. The You Earned It, You Keep It Act would end this entirely. Senator Ruben Gallego from Arizona, along with Representative Angie Craig from Minnesota, introduced this legislation to permanently eliminate federal taxes on Social Security benefits starting in 2026. Senator Gallego put it bluntly. Trump claimed he ended taxes on Social Security. My bill actually does it, permanently. That's a direct reference to campaign promises that didn't materialize in the recent tax legislation. But here's the key question everyone's asking. How would they pay for this? because eliminating Social Security taxes would reduce federal revenue by approximately $50 billion annually. Their solution is actually quite elegant and addresses a fundamental fairness issue in our current system. The bill would raise the Social Security payroll tax wage cap from the current $176,100 to $250,000. Right now, if you earn $200,000 per year, you pay Social Security payroll tax on every dollar. But if you earn $2 million per year, you only pay Social Security tax on the first $176,100. The remaining $1.8 million is completely exempt from Social Security taxes. Think about the unfairness of this system. A teacher earning $60,000 pays Social Security tax on 100% of their income. A hedge fund manager earning $600,000 only pays Social Security tax on about 30% of their income. The teacher pays a higher effective Social Security tax rate than someone earning 10 times as much. This change would mean anyone earning above $250,000 would contribute more to the system that everyone depends on. According to projections, this approach would extend Social Security's solvency from the current forecast of 2034 all the way to 2058, buying the program nearly 25 more years of guaranteed full payments. This is crucial because Social Security currently faces a funding shortfall. Without changes, the trust fund is projected to be depleted by 2034, at which point benefits would be cut by approximately 20% across the board. This bill would solve that problem while providing tax relief to current retirees. Now let's talk about what this could mean for your specific situation, because the savings could be substantial. If you're a single person with $30,000 in combined income and $24,000 in Social Security benefits, you're currently paying federal taxes on about $2,500 of those benefits. Depending on your tax bracket, that could cost you $300 to $600 annually in federal taxes you wouldn't owe under this new law. For a married couple with $50,000 in combined income and $36,000 in Social Security benefits, they might be paying taxes on about $18,000 of those benefits. In the 12% tax bracket, that's over $2,000 in annual tax savings. In the 22% bracket, it could be nearly $4,000 saved per year. For higher income retirees, the savings are even more dramatic. A single person with $60,000 in combined income, including $30,000 in Social Security, currently pays taxes on 85% of those benefits, $25,500. Even in the 12% bracket, that's over $3,000 in annual federal taxes that would disappear under this legislation. The higher your income, the bigger your potential savings, because more of your Social Security becomes taxable under current law, and you're likely in higher tax brackets on your other income. But, and this is important, we need to be realistic about the chances of this becoming law. While the bill has bipartisan support and addresses a real problem that affects millions of Americans, major changes to Social Security taxation are never easy to pass. The political dynamics are complex. Republicans generally support tax cuts, but are concerned about federal revenue. Democrats generally support protecting Social Security, but are divided on how to pay for changes. Getting both parties to agree on a specific approach takes time and political capital. There are competing proposals in Congress. The Retirees First Act from Senators Marsha Blackburn and Roger Marshall takes a different approach. Instead of eliminating Social Security taxes entirely, it would raise those outdated income thresholds. Under their plan, taxes would kick in at $34,000 for singles and $68,000 for married couples, instead of the current $25,000 and $32,000. This would provide significant relief to middle-income retirees while still generating some revenue for the federal government. Both approaches have merit, but they represent different philosophies about Social Security taxation and federal revenue. The Blackburn-Marshall approach is more politically feasible because it reduces the revenue impact. It would eliminate Social Security taxes for most middle-income retirees while still collecting taxes from higher-income beneficiaries. The Gallego-Craig approach is more comprehensive but harder to pass because it eliminates more federal revenue up front, even though it replaces that revenue through higher payroll taxes on high earners. Here's what's particularly frustrating about the current system and why these proposals are gaining momentum. You paid Social Security payroll taxes on every dollar you earned during your working years, 6.2% from your paycheck, plus another 6.2% from your employer, for a total of 12.4% going to Social Security. Then, when you start receiving those earned benefits in retirement, the federal government taxes them again. It's essentially double taxation on money you've already contributed to the system. Meanwhile, as Senator Gallego pointed out, high-income earners pay a much smaller percentage of their total income into Social Security due to that wage cap. Someone earning $176,100 pays Social Security tax on 100% of their income. Someone earning $500,000 only pays Social Security tax on about 35% of their income. The current system penalizes retirees who saved for retirement and have modest additional income, while giving high earners a pass on most of their income. This creates a situation where middle-class retirees often pay higher effective Social Security tax rates than wealthy individuals. It's a regressive system that hits hardest on people who can least afford it. So what should you do while Congress debates these proposals? First, understand your current tax situation completely. If you're not already doing so, track your combined income carefully. Remember, this includes half of your Social Security benefits plus all other income and tax-free interest. Many people don't realize that municipal bond interest, while exempt from federal income tax, still counts toward your Social Security taxation threshold. Second, consider tax planning strategies that work under current law. If you're able to control when you take retirement account withdrawals or realize investment gains, timing these around your Social Security taxation thresholds could save you money. For example, if you're close to the threshold where 85% of your benefits become taxable, it might make sense to spread large retirement account withdrawals over multiple years rather than taking them all at once. Third, understand the state tax implications. This federal legislation wouldn't change state taxes on Social Security. Currently, 13 states tax Social Security benefits to some degree: Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Utah, Vermont, and West Virginia. Fourth, stay informed about these legislative proposals. The outcome will directly impact your retirement budget, potentially saving you thousands of dollars annually. Sign up for updates from reliable sources like ssa.gov, aarp.org, or your congressional representatives' newsletters. Fifth, contact your representatives in Congress. Whether you support complete elimination of Social Security taxes or prefer raising the thresholds, your voice matters in this debate. Congressional offices track constituent contacts on issues, and Social Security taxation affects millions of voters. It's worth noting that this isn't just about tax relief. It's about Social Security's long-term sustainability. The "You Earned It, You Keep It" Act addresses both issues simultaneously by providing tax relief to retirees while strengthening the program's finances through higher payroll tax contributions from high earners. The timing could be significant too. If this bill passes this fall, the changes would take effect starting in 2026. That means you'd see the benefits when you file your 2026 tax return in early 2027. But let's be honest about the political realities. Major changes to Social Security, even popular ones, often face significant hurdles in Congress. Different parties have different priorities for tax policy and Social Security reform. However, The growing number of retirees affected by Social Security taxation is creating political pressure for action. When only 10% of beneficiaries paid these taxes in 1984, it wasn't a major voting issue. With 56% now affected, it's become a kitchen table concern for millions of families. The demographic pressure is only increasing. As baby boomers continue retiring in large numbers, more Americans are discovering they owe taxes on Social Security benefits they thought would be tax-free. The broader context matters too. With inflation having eroded retirees' purchasing power over the past few years, tax relief on Social Security benefits could provide meaningful financial relief to millions of older Americans. If you're currently paying taxes on your Social Security benefits, start calculating what elimination of these taxes would mean for your annual budget. For many retirees, it could free up hundreds or even thousands of dollars annually, money that could go toward healthcare, housing, or simply provide more financial security. Keep in mind that this would only affect federal taxes. Some states also tax Social Security benefits, and this federal legislation wouldn't change state tax policies. As for finding current Social Security news, the best official source is SSA.gov, specifically their newsroom section. You can also sign up for their email updates. For legislative developments, Congress.gov tracks all bills, including the You Earned It, You Keep It Act. The bottom line is this. After decades of more and more retirees getting caught in a tax system designed when far fewer people were affected, Congress is finally considering meaningful reform. Whether it's complete elimination of Social Security taxes or raising the outdated income thresholds, change appears to be coming. The question isn't whether these taxes are fair. Most people across the political spectrum agree that taxing Social Security benefits creates problems. The question is what solution Congress can agree on and when. For now, stay informed, plan based on current law, and keep an eye on these legislative developments. The outcome could significantly impact your retirement finances starting as soon as 2026.